Hello and welcome to a new episode of Meet East Capital. We will try to run through our perspectives on emerging and frontier markets today, which admittedly is not easy when we have this type of volatility. Today is Wednesday, July 8th. My name is Jacob Grapengiesser. I'm the Chief Investment Officer of East Capital. And joining me today, we have David Nicholls, who's Portfolio Manager for our Global Emerging Market Strategy. We will summarize the events in the second quarter and the first half. So, David, why don't you kick off, please?
Sure, yeah. So if you look at Q2 2026, really a continuation of what we saw in Q1, which is emerging markets performing very, very well and strongly outperforming really the rest of the world. So yeah, emerging markets ended up Q2 up 24%. Compared to the S&P, which is up 15%. That was driven, as probably most people are aware by now, by Taiwan and Korea that were on an absolute tear. So yeah, Taiwan up 49% in the quarter, Korea up 88%. Having said that, I think obviously all the focus is on these countries, but it's nice to see a decent bounce back in countries like India and the China A shares that probably have gone a bit under the radar. But I think also worth paying attention to, particularly now, as Jacob said, when it gets a bit more choppy. I think, yeah, we'll sort of return to the main drivers a bit later, but probably the main sort of theme of our CIO letter this year was a new era for emerging markets. And what is the new era? I mean, it's really what I'm showing you now, which is just how the sort of the emerging markets look, right? And for years, it's been dominated by China with a sort of handful of other countries. But over the last few quarters, or really the last quarter, you've seen Taiwan and then Korea overtake China. So currently, if you're looking at it, Taiwan and Korea make up almost 50% of the emerging market index, which is, of course, a very different story to what you would have seen, or what we've been seeing over the last 10 years. Which means that, yeah, AI is extremely important. That's something we'll definitely come back to. I think the sort of the main point that we take from this is that no one would have expected these moves at the start of the year, but that is exactly why we have actually a country neutral approach in our emerging market strategy. So we don't try and make these big country bets because it's very difficult to time. So we weren't worrying about sort of what our Taiwan weight or our Korea weight is. Actually, we just say, no, Korea is 25%. How do we best create a sort of portfolio of Korea stocks that we think will outperform the Korea part of the benchmark? And that's proved very helpful in Q2 and even now. But yeah, that's really it, I guess, on absolute performance. Maybe, Jake, if you want to highlight a bit on the relative performance, which is also, I think, quite strong.
Yes, it's actually been great. I think it's been the best year ever in terms of relative performance. So we had a 13.5% alpha or outperformance versus the benchmark for the first half this year for the global emerging market strategy. We had a solid 2%. 2% is much less than 13, of course, but 2% is still good for the frontier market strategy. And we had some countries there, like, for example, Nigeria, performing really well. So I think you've seen a bit of a revival for the frontier markets as well. But David, why don't you run through some of the numbers or details on the performance side?
Yeah, exactly. I think one of the most overlooked points when you look at these huge performances, Korea up 119% year to date, Taiwan up 63%. This is as of the end of June. It looks almost quite scary, but what's really important, particularly in Korea, is this has been driven really fully by earnings, and actually Korea's got cheaper since the start of the year. That's also the case for India and for China, which have also derated. So as a whole, emerging markets has also got a bit cheaper since the start of the year, despite this very strong performance. I think that's a bit overlooked when you just look at the headline numbers. So definitely something worth bearing in mind when we think about the sort of outlook for H2 and also going forward. But yeah, we sort of circled around AI a bit, Jacob. I think probably now it's time to dig into it. What is our view on AI?
Yeah, so I think there's a usage view, right? How much this will be adopted and used, and there's a market view, right? So I think if we start with the usage, I think it's perfectly clear that AI has now reached the masses, right? It's becoming a properly useful tool, and I think Claude especially is illustrating this, right, with Anthropic. We can speak for ourselves. I think, my tokens, I think most of the team members' token, they typically round out quite often, right? Which means that you actually use it a lot. So I think you're seeing this S curve, right? I think we're sort of somewhere in the beginning of the S curve where the pace of usage is actually accelerating. So I think this is very much the case in terms of how people are adopting it. I think what it means for markets, I'll talk a bit about the details later, but for example, for memory, which has been one of the big trades this year, in 2024, only 8% of the capex when you were building these new server parks was on the memory side, right, on the memory chips. But for each generation of NVIDIA chips, actually a larger and larger proportion goes to memory. So if we look on this year, it's about 30%, so 8% versus 30% that actually goes to memory chips. And that percentage is going to increase over time. So I think that's very interesting. And what does it mean for the DRAM prices? Well, now we talk about HBMs, right? High bandwidth memory chips. So those are the ones that you would need to spend more on for the more advanced NVIDIA and other, of course, processing chips, right? But for the DRAM prices, well, actually, there's less and less DRAM capacity because the big chip makers are using the capacity for HBM. So the DRAM spot prices are also ticking up. I think this quarter you might see 40 to 50% increase in DRAM prices, which obviously is very substantial. Yes, but David, the Korean market has been very volatile in the last couple of days. Why don't you tell us what's going on?
Yeah, sure. So I think another really interesting point on Korea is that actually, if you look year to date, foreign investors like ourselves have been net sellers, selling almost $100 billion of equities. And that's, of course, been on the other side. You've actually seen retail investors pouring in money, and over the last few months, particularly through leveraged ETFs. And so even if you look at, for example, in Hong Kong, the fastest growing ETF of all time is a double leveraged Hynix ETF. And that now represents almost 13% of the entire Hong Kong ETF market. So this is just in Hong Kong. In Korea, it's actually much worse and much more serious. And only last week, the Korean regulator finally acknowledged actually that introducing these leverage ETFs was a bad idea. But what it means is that volatility will remain extremely high, right? If the market's really driven by a lot of retail investors with double or triple leverage ETFs, yeah, it is going to be choppy, and that's definitely something you've seen over the last few days. So as a result, we have actually reduced our position in these stocks. But in times like this, we really want to stick to fundamentals. We are a fundamental investor, and we were talking this morning actually on our morning call about the cash flow generation from these companies. I mean, this is sort of a valuation approach we've used often for these memory companies. But I updated the numbers today, and even compared to last month when I updated it, the cash flow estimates for next year are already sort of 20 or 30 billion higher than when I last updated the table. But essentially what it means is that over the next 3 years, the two large memory companies are going to generate over $1 trillion of free cash flow. Of course, the hyperscalers moving to negative free cash flow, these guys moving to $1 trillion. And that's represents around 50% of the market cap of each of these companies. So this is, of course, huge. And yeah, there are debates about how you value these companies, but there clearly is value there, at least based on our how we look at it. I think what's really interesting for Hynix is that this Friday, Hynix will list in the US for the first time a DR and raise about $28 billion of funding, which will be very exciting and definitely potentially a trigger because, of course, Hynix, it's no longer drastically cheaper than Micron, but you're still getting one and a half turns cheaper on PE than Micron, despite, we would argue, a more dominant sort of superior offering in terms of technology and scale and things that they can offer. So yeah, but Jacob, I mean, as you mentioned, it's been quite an exciting period. Can you take us a bit through sort of how we have positioned and traded during this period?
Yeah, So if we take a few steps back, we started to increase our positions in the memory names roughly a year ago. So in June 2025, that's when we put up sort of large positions in the memory names. That had turned out exceptionally well. Possibly we sold a bit too early some of these memory names. We sold them in January and February. In total, we were about 4 or 5% overweight in Korean memory names, which would be Samsung and Hynix, even though we have a company called SK Square, which is effectively a holding company for Hynix, trading at a 50% discount. So you basically buy, two shares for the price of one, to simplify, and that discount might decrease over time when the board is changed in March next year. We'll see, but this 50% discount feels pretty comfortable. So the memory trades we were doing quite early. Then we made a trip to Korea in December. We realized that just before Christmas is a good time to meet the companies. They're probably not as busy as perhaps they are otherwise. And for example, we met a company called Samsung Electromechanics. This now gets very technical. So Samsung Electromechanics is one of the 2 large producers of multi-layer ceramic capacitors. It's effectively a small, like a size of a pea, that regulates the sort of electricity and the power to chips. So we thought, okay, this is very interesting, because for the new, more advanced chips and for the servers, if a regular standard servers use about 2,000 of these multi-layer ceramic capacitors, the latest NVIDIA ones would be using 400,000. So from 2 to 400,000, right? These are not so difficult to produce, but it's just like an explosive demand. So we bought shares in this company and some other sort of bottleneck chip companies, not the memory names, but because we were already selling those, right, early in the year. So early in the year we were selling memory, and we were buying other sort of bottleneck type of companies, producing capacitors, producing other sort of bits and pieces of equipment where there was a real shortage. Here you can see on the chart where we bought Samsung Electromechanics, and then we were aggressively selling it. I'm of the opinion that stocks, they don't go up forever. So you better sell, you better take profit. And you can see the green dots are when we were buying, and then the red dots are when we are selling. And now we have effectively sold all of these shares, or close to all of these shares, right? Maybe we're a bit lucky with the timing. I think the stock is down 30% from peak levels. But for us, it doesn't really matter, right? I think what we have done is that we have rotated about 10% of the fund from this more sort of high beta AI tech exposures to more traditional industries, especially in Korea. And why did we do that, right? I think we were also in December last year and then earlier this year, we were meeting a lot of the, let's say, regular companies, right? We were meeting a company that produce like a water purifying device that most Korean households would have, and you effectively rent it. It sounds like a very crazy business idea, but you don't drink the tap water as you might do in certain European countries, but you actually rent this water purifier. But it's sort of a compounding company, right? Because they were renting out all these water purifying machines, but then they added on other things like mattresses. I mean, it sounds crazy to rent a mattress, but that's a business idea that works in Korea. So we looked at all of these companies. We said, this is great. This should be like a P20 type of stock. And they were trading at the time at 8 times earnings with 15% earnings growth. So we added this company. We looked at K-Beauty. So I think the whole beauty market is becoming a bit disrupted. You have this sort of the legacy brands that, I guess, especially French brands, are being challenged by, as they say, indie brands, so smaller brands. We looked at a company called APR. They have 6 out of 10 best-selling products on Amazon in the US for skin care, for skin creams, right? I visited the company and I gave some of these creams to my wife, and she said that, you know, the amount of compliments she gets for her kind of glossy, shiny skin is unprecedented. So clearly she's supporting this usage case. But we also bought, so for example, sales of APR, which is producing these top-selling creams, is up 172% in the first quarter. So just staggering numbers, right? But we also bought a company like Cosmeca, which is producing the actual ingredients. You know, you have the sort of the brands doing the marketing, the design, everything, right? But then you have the sort of component producers. So even though the consumer preference taste from, you know, one brand to the other, the producer of the actual cream will still be there, right? So Cosmeca was, for example, I think growing earnings 52% in the first quarter and trading just above 10 times earnings, you know, and that's a probably more stable business model. So we were doing a lot of these kind of shifts in the fund, right, to basically companies that we don't know when they will perform, but of course we think that at those type of valuation levels they should be performing. Anyway, so a lot of work and a lot of changes on the emerging market side. If you don't have any AI exposure, you know, we recommend typically the frontier market strategy, which is sort of free from any AI volatility, which, you know, might be a good thing days like this. What do you say, David?
Yeah, exactly. So I think that's exactly the point. It's the frontier markets, you know, on the face of it, had a quieter period with the index returning 11%, and as Jacob said, us generating 2% of alpha. But actually, that's exactly the frontier market story, right? Is that it is a surprisingly low volatile, uncorrelated sort of asset class, basically, that just steadily delivers this sort of roughly 20% dollar return year after year after year with low volatility and very low correlations with the rest of the world. So basically, yeah, as you said, it delivered exactly what we would have hoped it would do. If you want to sort of break it down a bit more in terms of alpha, actually in this year it was very much Nigeria that was driving a lot of alpha. In terms of some of the banks, the rows were up sort of 20% in the second quarter. Still look extremely attractive at 3 to 5 times PE, around 1 times book value, with almost 30% of ROE, dividend yields of 11%. So we still think this is attractive. And actually in the quarter, we did one of our first trips to Nigeria for a while and saw this new Dangote refinery, which is an incredible success story that really no one said would succeed. And yeah, I think really reinforced our positive long-term view on Nigeria, as well as highlighting a few interesting companies we need to look more at. In terms of other travel, as usual, very, very busy quarter. You know, we're in Brazil, Korea quite often, Czech Republic, Greece, as well as a lot of meetings in sort of home countries where our analysts are based, India and China. I think I personally spent 2 weeks in London meeting Indian CEOs who like to come to London actually during tennis and cricket season in June when it's very hot in India. And I think I really came away with the view that actually India is not nearly as bad as the negative sentiment suggests, and their sort of quite weak market performance. Actually, these companies are growing well, delivering decent growth, not too concerned about the macro, with even sort of the largest banks expecting loan growth of 15%. So you're getting, decent earnings growth with attractive valuations. So definitely a bit more constructive on places like India after those meetings. But yeah, Jacob, we usually finish with a outlook. Obviously, as you said, it has got a bit choppy now. But yeah, what can you tell us about how we're expecting H2 to go?
Yeah, so first of all, I mean, the AI trend is not going to go away, right? I mean, it's certainly here to stay, and we are somewhere in this S curve, right? Probably in the beginning of it. So when markets are this volatile, and I've seen it quite a few times in my career, I think stick to fundamentals. I think this is really the best way to do. On our end, we were sticking to fundamentals, and we were actually getting quite worried about some of the valuations, which is why we decreased 10 percentage points, or rather switched 10 percentage points of the fund to more sort of conservative, sort of low valued type of sectors. We always care about valuations, right? So I think that's the first thing. If you look on companies like Hynix, again, like 5 times earnings for next year, that is not expensive. Can it go down to 4 times earnings? Yeah. Can it go down to 3 times earnings? It can, but probably it won't, right? So that's the first point. I think secondly, if you look on the strategy overall, well, I just looked at the numbers this morning, and for this year, our global emerging market strategy has 81% earnings growth at 13 times earnings, or P ratio of 13. That's a bit amplified by, again, the chip makers, right? So if you look on next year, which is probably more of a normal year, we're looking at 10 times earnings and 30% earnings growth, which, I still think is very attractive. That's a PEG ratio of 0.3, 0.4. On the frontier market side, and again, the frontier market fund is strategy is what you should be buying if you're worried about AI. That is trading at 6 times earnings with sort of mid-teens type of earnings growth. So I'm relatively calm going into the summer, both with the positioning and with the markets. We might see more volatility, but we also have a major trigger with the listing of Hynix in the US, or Hynix DRs in the US by the end of the week, which I think would be a very interesting event. Another important factor is actually the oil prices. No one really talks about it. We just say that, well, prices are back to sort of pre-Iran conflict levels. But this is important, and we have very little or zero oil exposure in most of our strategies. And if we look on next year, there is a 5 million barrels per day surplus, roughly 5% surplus of oil production. So I think it's relatively likely that we can see oil prices going lower, and if not much lower. And this would clearly be supportive for the world economy, and perhaps in particular for some of the emerging markets that are large oil importers. So we'll see what happens on that front, but that might actually be a bit of a surprising driver for some of the emerging and the frontier markets. With that, thank you very much for listening. We'll see you in 1 quarter again. Thank you.